Day two of a Trump-driven equity rally. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is on assignment today, and Bloomberg Open Interest starts right now.
Coming up, Jerome Powell faces a tough test in the new Trump era. The Fed is set to cut rates later today. As Trump's win continues to ripple across markets, we'll get the outlook from Mark Bristow, the CEO of gold giant Barrick, plus a check on chips, I should say. Qualcomm jumps on a bullish sales forecast, while ARM drops on a more tepid outlook. Let's take a look at where markets are trading right now. In terms of futures, we continue to see gains. Okay, they're not huge, right? But we're up 0.25% on the S&P, and NASDAQ futures are up a little bit bigger. 10-year yield coming down. This is essentially a dead cat bounce because we did so much yesterday. We're letting off a little bit of steam today. You can see the yields are still about 440. The gold price is coming up 1%, and at 2684, it's not that far off of its all-time highs. Bitcoin isn't that far off of its all-time highs either. Coming down 1 2/3%, but still almost $75,000. I remember when I first started covering Bitcoin, and I could have bought one for $75.
Just incredible. Was that 4 decades ago?
No. One decade.
We know you love to talk about your age. Anyway, some movers to watch here. Qualcomm surging today as it sees strength in the Chinese smartphone market recovery. We're going to talk about Qualcomm more in this show here because, of course, it is one of those stocks that Bloomberg has previously reported was considering M&A, potentially even when it comes to Intel. We will get there later in the show and talk about those details. ARM, on the other hand, maintained its annual outlook, but warned for a slow smartphone recovery that could overshadow AI progress. Also, keeping an eye on Lyft moving higher after reporting record trips for the quarter and seeing progress in its commuter program. And next hour, we do speak with the CEO of Lyft, Matt.
Yeah, absolutely looking forward to that conversation with Ed Ludlow. I just want to point out, that the Fed meeting has been kind of overshadowed by this Trump win, but we're still going to focus in on what to expect. This chart looks at what the market is pricing in for next year, right? Today, they're very likely to just continue the status quo and cut 25 basis points. But next year, it is shocking to see how much has come out of market pricing. We were looking for 170 basis points of cuts, and now the market is only pricing in, Sonali, 75 basis points of cuts next year.
And it's interesting to see what this is all meant for the push-pull between short-term and longer-term interest rates. We didn't hit the 4.5% level yesterday. That was the critical mark.
On the 10-year yield.
On the 10-year yield. That was a mark that a lot of traders were watching for. And given that not only did we not hit that mark, we've also seen some of a give back. I think that really shows that there's a little bit of uncertainty here still.
You had a huge run-up in rallies yesterday, and today we're giving off a little bit, right? That's
just a little bit.
That's what I would call a dead cat bounce.
What I'm watching still is that House race, which is still outstanding and will matter for tax policy. Maybe not tariffs, as you've pointed out before, but definitely for taxes moving forward.
100%. That is really the keystone here to a government that's allowed free reign in 2025. Let's bring in Nadia Lovell. She is senior U.S. equity strategist at UBS Global Wealth Management. Nadia, first of all, great to have you here on set. Thanks for joining us in person at 731 Lex. We saw yesterday essentially a replay of what we saw in 2016. So can you look at 2016's playbook and just chart a course forward for 2024?
Yeah, we normally get a rally after election, so that's nothing new. And we had expected that you would see a bit of a rally in the market if Trump did win. And so yesterday wasn't too surprising to us to see financials and small cap outperform. But what was surprising was the magnitude. Remember, after the win in 2016, day one, the market was up a little over 1%. Yesterday, we got more than double that, right? So that was surprising. But I think also what's happening in the market is that the fundamentals in the market itself remains pretty solid. You're entering a period of seasonality. You're also having buybacks come into the market. And let's not forget, the economy is actually doing really well, right? And earnings as well. And so not surprised to see the market continue this momentum into the year end.
today, the 10-year, to Matt's point, did not give back that much of the loss yesterday. You're just under 440 still. With the expectation that interest rates could be higher than expected, at what point do you have to worry that that spills over into the stock market?
I think that's a great question. It's something that we're all watching. But remember, it's not so much a level of rates that matters for equity, is why are rates higher and the velocity of that move. And so we've seen, the 10-year move up about 80 basis points off of the September low. And so we're watching, like, do we get closer to 5%? I think that then you start to see some impact to equities. You are seeing already some impact to the interest rate sensitive areas of the market. I mean, utilities, real estate as well. You're seeing a bit of a pullback there. But if the movement in rates is growth driven, we talked about stronger economic growth, then equity markets can absorb that. And we've seen it, multiple record highs.
Matt, it was interesting. Jay Hatfield yesterday said his 6,600 assumption for the S&P next year was contingent on 3.5% 10-year.
Yeah, absolutely. I mean, he thinks that rates are going to come back down again. I think he's looking at less of an inflation bump than a lot of other people are expecting. Who knows what's going to happen if or when Trump puts tariffs in place. We do see, Nadia, as I pointed out at the top, markets pricing in far fewer cuts from the Fed for next year. I think the chart is 291 if you want to pull it up on your Bloomberg at home. Only 75 basis points. We were looking at 170. That's a dramatic repricing of expectations.
Absolutely. I mean, we are all looking for 25 basis points cut today, and we think we'll get another 25 in December. And next year, we're still at 100 basis points cut, less than what the market is pricing in. But, we do think that, yes, Powell has said multiple times, Fed isn't political, but the Fed is data dependent. And so a lot of this is going to depend on the data on the new administration. We have to recognize that fiscal policy as well as trade policy and immigration can have an impact on inflation as well as economic growth. And so if those two things start to accelerate, it could make the work for the Fed a little bit more challenging in 2025. But at the same time, you have to consider that if we get a bump up in inflation from tariffs and a push down on growth, the Fed is probably not wanting to have interest rate too high because they're going to be concerned about the growth picture.
What is the most underpriced risk in markets right now, particularly if we see the tariff policy as aggressive as Trump had come out and said he would make it?
I would agree with that point. I think that is the most underpriced risk right now. You're seeing things like small cap rally. Yes, we probably will get some deregulation. We'll get a more domestically focused economy. And those are all great for small cap. But if you look back to, the 2016 playbook, the 2018-2019 trade war, small caps actually underperform. And so you might think that small cap is not impacted by tariffs. But remember, small cap is sensitive to economic growth, sensitive to the capex cycle. And those things can be a headwind if we see these higher tariffs.
Yeah, it's true. Stocks did really well under Trump in his pre-COVID presidency, right? After 2020, things went a little bit haywire, I think it's fair to say. But big tech did the best, at least as far as the major indexes. The NASDAQ 100 was up, I think, 70-some%. The S&P was up about 50%, and small caps were up like 25%. Do you expect big tech to continue to outperform? Because we've run so far so fast. I think Torsten Slok put out a note a couple days ago that showed that the top 10 stocks in the S&P 500 have an average PE of 50. That's pretty heavy.
Yeah, we think that the tech run can continue. Can we have some periods of pullback? We did see that over the last few weeks, absolutely. But we actually came out of the earnings season even incrementally more positive on tech. Why? Because the numbers put up, particularly within the AI space. The capex boom is happening. We actually lifted our expectations to the 4 hyperscalers. We think that you're going to see another 20% growth on capex for next year on top of the 50% that we got this year.
That's like, what, $500 billion of spending from those companies alone?
From those companies, $270 billion of spending from those companies alone. Yes, there's still questions about monetization, but if you look at throughout the earnings season, you did hear from some of these companies talking about improvement in terms of advertising and penetration there. You also heard from Microsoft, without offering a single stock view, that reality is they weren't able to deliver the cloud growth that people expected because they're bottlenecks. They're not able to get these data centers online as quickly as the demand is needed.
So it's interesting on that point on big tech Nasdaq. Also, you had data track out this morning saying that the U.S. large caps, they didn't just beat, they beat the broader U.S. equity market by a wide margin in Trump's first term. But the difference now is the bottlenecks that you've described, but also valuations. So do we think here at this juncture, if you bet on tech today before Trump is inaugurated, then do you see that outperformance over the next 4 years like you did last time?
Well, you know, the magnitude is always up for debate, but we still expect outperformance. You know, our valuation's elevated, absolutely, but a lot of these companies can grow into that valuation. We're continuing to see upward revision to some of the EPS. And once that monetization of AI starts to really ramp, we expect to see some upside to tech. But yes, valuation is something that we continue to watch, but we think that secular story behind AI is very much intact.
Plus maybe some M&A coming back.
Yeah, well, no, for sure. And that's something that we're going to focus on this program in the next few weeks, for sure. Nadia, in terms of the House race, it still hasn't been decided. I note that a lot of votes are due to come in from California, which is, you know, historically left-leaning. What happens if there isn't a red sweep? What happens if the Democrats take the House? Are then all bets off on deregulation and lower taxes?
Well, you don't need a unifying Congress to do some of the things that Trump wants to do in terms of deregulation. A lot of this will be up to the heads of the different departments, right, in terms of he will put in place for the different agencies. Yes, the corporate tax part of it becomes more complicated and unlikely that we will get that. And then we have to offset that with the potential for higher tariffs. But we think that ultimately it's still a net positive for the market. We know that President-elect Trump cares very much about the levels of the S&P 500. And so we do think that the administration is better prepared now to be able to manage to do some of those risks. But yes, the ability to get all of that agenda through, we know, has to be in a unified government.
Well, to that point on taxes, say we do not get a full red sweep. How in play are taxes, particularly because the deficit we're looking at this time is so much wider than you saw in the last term he had?
Absolutely. I mean, it's 2 times, you know, as a percentage of GDP than it was in the first term. So yes, even in a red sweep, you're not sure if you're going to get everything through. There's going to be gives and take. And so I think even in the red sweep, you're looking at some potential, you know, rollback of some of the IRAs. And that's why you're seeing some of those green energy names under pressure. But, you know, even with a red sweep, there's going to have to be some negotiation. Like, are you going to get the 15% cut to corporate taxes? Unlikely. Maybe it comes down to 20%. I mean, we've heard of President Trump, elect President Trump, talk about that 15% is really for those domestic manufacturers. That's complicated. We don't even know how that's going to be implemented. I mean, who determines whether something is, made in the U.S. or not, if you're importing parts into the U.S.? So we'll see. I think that taxes is something to watch. And, of course, the higher tariffs, which could come faster than the tax cuts.
Nadia, thank you so much for your time here. Of course, a lot to digest in the market here. That is Nadia Lovell of UBS Global Wealth Management. Now let's get a look at some stocks moving ahead of the opening bell. We're going to bring in Abby Doolittle.
Let's start off with the shares of Datadog. They're down just a bit here, down 2%. This after the cybersecurity company essentially put up a good, decent third quarter, but the guide looking ahead a little bit less than what investors had wanted. That's true, too, for some of the dating app companies. A bit of a mixed bag here for connection platforms. We have the shares of Bumble right now down about 6%. They put up a massive loss. That view disappointing, but Match down even more, down 13.6%. They missed the sales number for the third quarter, and the fourth quarter view is seen as very disappointing. On the other hand, AppLovin, the connection platform among customers, well, that stock is absolutely soaring into today, up more than 300% on the year. There is a 10% short interest there, so that could be a piece of it. But they just beat adjusted earnings by 34% sales, so clearly the stock being rewarded. And then finally, let's take a look at the shares of Moderna. There's also a decent short interest on this stock. Into today, down almost 50% on the year, but they put up a big sales beat. 48% based on that COVID vaccine. Sales coming in for the third quarter at $1.8 billion versus the estimate of $1.2 billion. Investors liking it, sending those shares up 6.3%.
All right, Abigail, thanks very much. Abigail Doolittle looking at some of the stocks moving ahead of the open. Still got about 16, 17 minutes to go until the opening bell. Coming up, gold prices are stabilizing after an election day shock. We'll discuss the outlook for commodities with Barrick Gold CEO Mark Bristow next. This is Bloomberg.
Something that was not caught up in yesterday's rally was gold. It's steadying now after plunging more than 3% yesterday as the dollar strengthened on Trump's presidential victory. Now investors shift their focus to this afternoon's Fed meeting, which could help gold. Joining us now is Mark Bristow, Barrick Gold president and CEO. Barrick is one of the world's largest gold producers. Talk about the cross currents here, because there's monetary policy, there's geopolitical risk, and now there is some certainty to the U.S. election, but still a lack of certainty around what the policies will be. What are the biggest inputs on what is driving the gold price higher to the extent that it will go higher from here?
So, Nadia, I think, first of all, we got to appreciate that gold is at a good place right now at 2,700. What we've seen is a reaction to an uncertainty in the United States. I think that big drivers of gold are still going to be de-dollarization by central banks. In the last 2 months, we've seen the Western investors come into the ETFs with ETF inflows, and we've still got that big overhang with the indebtedness of the developed economies in the West and the softening of the China economy. So still very bullish for gold as we sit today, and I think everyone's waiting to see what the new president of the United States says about, and more importantly, what he does, given what he promised through the elections.
Yeah, I wonder, Mark, about gold's role as an inflation hedge. Certainly, yesterday's event, while maybe not surprising for markets, certainly was a surprise to, pollsters and I think many in the media. And you did see rates rise dramatically in the bond market on expectations of inflation due to tariffs. We don't know if that's going to happen. We don't know if they're going to actually cause inflation. Nonetheless, that's how the bond market interpreted it. Why doesn't the commodities market have the same interpretation? Why don't we see, a knee-jerk jump in the gold price when we have what most people expect to be an inflationary event?
So, Matt, I think that you saw confused indicators in the markets across the whole market, and I think what it was is, first of all, a message that people felt that maybe the Republican Party, and particularly Mr. Trump, was good for the economy broadly. But then, to your point, there are these uncertainties, in particular his statements around tariffs. I think there's a broader base that broader set of indices that are driving the gold price, and that is that inherent global economic risk. And that's been the fundamental driver of gold now for well over a year.
I also want to switch gears and not just talk about gold, but also copper, a place that you have been diving even further into, and wondering what a Trump victory means for the copper market, particularly with the policies that he had said he would put in place, particularly when it comes to any setbacks to the energy transition and tariff strategy.
I think, Sonali, the copper is a fundamental metal. I always say copper is as strategic as gold is precious, and it's a fundamental metal in any construction-led economy, and definitely we're going to see that. And I think the world is going to be short of copper. So I don't believe that Mr. Trump and any policy introduced will impact the demand side of the copper equation in the medium to long term. In the short term, we're going to have lots of interference in copper, in that we have a brief period of projected oversupply before that demand equation kicks in. And I think that'll be compounded by everyone waiting to see what the policy of the new government in the United States will be. And we've still got China on the other side, producing lots of metal, putting it into the market, but on the back or on the basis of a softer economy overall.
I wonder what has been the driver in real terms, in direct terms, of the rise in gold prices. Is it government gold buying? Is it central banks around the world? I mean, you said something to the extent of, it's a hedge against economic uncertainty globally. Who are your biggest actual buyers?
So, Matt, the biggest are the central banks de-dollarizing their reserves, so shifting some of their reserves into gold, and we've seen that going on for a while. What's been interesting up until 2 months ago is the absence of investment into the ETFs, and that's really the way the Western investors invest in gold. And then you've got the big owners of treasuries, China and Japan to a lesser extent, and we've seen all those holders of treasury bonds lightening up on US dollars, and a lot of that goes back into gold. And then you've got all the other drivers as far as overall risk. And one of the biggest risks that people haven't really focused in is the budget deficits we see across the Western economies.
All right, so de-dollarization and big budget deficits, maybe things to focus on. Mark, great to get some intel from you. Thanks so much for joining us. Mark Bristow there of Barrick Gold. We are nearing the opening bell, and we continue to see equity futures gain in terms of a reaction. Day 2 to the Trump victory. More market coverage ahead. This is Bloomberg. Welcome back to Bloomberg Open Interest. We have just 20 seconds to go until the opening bell on basically day 2 of Trump 2.0. In terms of futures, we do see gains again after the big gains in the cash trade we saw yesterday. S&P futures up 0.3%. NASDAQ futures doing a little bit better. We have the Russell 2000 futures down, but yesterday in the cash trade, the Russell 2000 was up 5.8%, which it's huge. As we have been talking about. All right, down the New York Stock Exchange, we see Liz Claman there, as well as people who are building homes for heroes, I guess. I think VP of Lowe's is on that board, and it's a charity organization. Down at the NASDAQ, Okta has a pretty cool contest where they pick the best software as a service, like startup. And so you've got a bunch of kids down there who are probably going to be super gazillionaires someday. In terms of the major averages, we have likely gains here. This is a cash trade behind me, no longer futures, and it looks similar, right? Up 0.33% on the S&P 500, NASDAQ 100 up 0.6%, and the Russell 2000 a little bit of a give back. There are some individual stocks that you're going to want to keep an eye on today, and I feel like chips really is the thread that we can pull out of the group. Because Qualcomm gave a positive outlook yesterday, the phone business seems to be going well. You still need chips for phones, right? And Qualcomm stock is up 3.6%. ARM Holdings, on the other hand, bummed people out, warning that AI potential could be overshadowed by its close ties to the smartphone market. ARM Holdings, the chip designer there, down 2.2%. Sonali, what are you watching?
Interesting to see things go two ways. I am looking here at Lyft, just soaring here, reporting a record number of trips for the most recent quarter. The company is signaling its plan to attract more commuters, and the plan is working. We're going to speak with the CEO at 10:30 a.m. Eastern. Lyft now up almost 23%. Also taking a look here at DJT, taking a turn lower after surging yesterday on Trump's victory. Remember, though, the stock has risen 105% this year as of yesterday's close. Now you're down almost 13%. You are off the highs of this year. We will keep an eye on that. We're going to take a closer look at election-related movers with Bloomberg's Abigail Doolittle.
Yeah, well, absolutely, Sonali. This is really pretty incredible. I don't have to tell anybody about yesterday's risk rally. It was stunning to see the gains that we saw for stocks right across the board. In fact, yesterday's gains were better for many of the markets that we watch than when President-elect Trump won in 2016. For instance, the S&P 500 well above the 1.1% gain back in 2016. The Russell 2000, Bitcoin up 10%. And I don't think that Bitcoin was a part of the narrative at that time for President-elect Trump and his administration. But the dollar, it's really interesting, almost... I'm sorry, what's that?
He was against it back then.
Well, he's had a major turnaround,
yes.
and his now support really seems to be helping out Bitcoin, being up 10%. And that dollar, about an even gain yesterday, the best day since 2020, and then the next high had been that 2016. And then the 30-year yield, I think that yields bonds really telling us that a Trump administration spending, well, it could cause those yields to go higher. Let's put yesterday's gain into perspective of not just the prior time when he won in 2016, but all presidential elections. And we're going to see it's the biggest gain ever, up 2.58% for that S&P 500. The next best up 2.2% when Joe Biden won, President Biden won back in 2020. And then you can see actually lots of election day losses the day after. But the point is, yesterday, that is the best post-election day gain ever. And then finally, Sonali, you were just looking at DJT. Let's take a look at the Trump trade after the massive move higher yesterday. Yes, DJT giving some of it back off of the low, still up more than 200%. Coinbase giving some of those gains back down, 2.3%. Bitcoin. And then yesterday's big winner, and Sonali, this is probably one that you had your eye on, that KBW Bank Index up yesterday, 10.7%. The expectation of less regulation, the best day since 2020. Well, now some of those gains are being given back.
Yeah, I think some of this is fascinating. Sonali, we were talking about the fact that, you know, a lot of times, obviously, when there's a huge move up, you can expect to move down, or vice versa. But something like DJT, which is already kind of meme stockish in its own way, at one point yesterday, it was up 35%. Then it closed only up 6% and has now erased all of those gains and more today.
Well, I think for some of these trades, think banks, for example, you look at the rise in longer-term rates and you wonder about whether that will really help the regional banks in particular or not. Cross currents that investors are playing with here.
Yeah, or if it's going to help the small caps that rallied so hard. In fact, I'm going to start our interview with Abby Joseph Cohen on that question. Sonali, let's bring in Columbia Business School professor and retired Goldman Sachs partner Abby Joseph Cohen. We're pleased to have you on the program. Thanks so much for joining us. Yesterday was fascinating in so many ways. But one of the, I think, main threads I pulled out, at least of the market reaction, was that we had this huge rally in stock. As our Abigail just pointed out, it was the biggest post-election rally that we've ever seen. But small caps especially outperformed. At the same time, we had a giant sell-off in bonds, pushing yields on the 10-year to almost 450. The 30-year sold off more than it has since 2016. Now, those two things can't hold, right? We can't have this gain in small-cap stocks and higher rates because those are the companies that need financing the most.
Well, Matt and Sonali, first of all, thank you for giving me the opportunity to be here with you today. Yesterday was truly an extraordinary day, and Matt, I think you've laid out some of what has been referred to as those cross currents. Let's remember that one day does not a market make. Obviously, it was very exciting for traders. It was a very interesting day in that regard. But let's think a little bit more long term. Maybe another week or two, for example. But your specific question on small cap and mid cap is really quite interesting. Yes, all other things being equal, higher interest rates, which is clearly what the bond market was telling us yesterday about the direction of rates, higher interest rates, higher cost of capital, a problem for small and mid-sized companies that tend to be reliant on debt. On the other hand, these stocks offer very good relative value vis-a-vis the large cap names, especially the mega cap names. Now, the mega cap names and some of the others are very cash rich, and they don't need to go to the capital markets to finance themselves. The small and mid-sized companies do, but I think what investors are looking at is the relative opportunity where PE ratios, for example, price to sales ratios, are dramatically lower for these smaller companies than for the larger companies.
You know, to that end, you look at the move in longer term interest rates, it's significant. And at what point does that start to catch up? The expectation here is that next year you might see what you saw in the first year of the Trump term, you know, the last Trump term rather, where you had kind of muted volatility, but then volatility started to pick up. Will the bond market start to eat into the stock market's calm?
Yeah, well, let's back up a little bit. and recognize that the movement up in mid-range and long-term interest rates began a few weeks ago. And part of that, I believe, was a belated recognition that interest rates had moved too low. Not because inflation is out of control at this point, but rather because the economy is continuing to grow, and we're looking at a yield curve that was incredibly flat. One of the things to keep in mind is that as the Fed thinks about its decision today, it will be impacting only the Fed funds rate, right? Only the very shortest end of the yield curve. Those intermediate long yields have been moving higher. And as you point out, as they do, that creates, all of the things being equal, an obstacle for valuation. However, the U.S. economy shows no sign of recession at this point. The economy is growing well enough that corporate profits look quite good. The guidance that companies have been giving for 2025 is positive. So the valuation responds to several different things, and I believe right now investors are looking at the prospect for a long, sustained period of economic growth and corporate profits continuing to increase.
You know, I referenced earlier Torsten Slocknote. Out of Apollo, Torsten sends amazing tidbits every day that are super interesting. A couple days ago, he pointed out that the top 10 stocks in the S&P 500 have an average valuation of 50, a PE of 50, which is aggressive, to say the least. You talked last time you were on with us about concentration risk, and I think it's only gotten worse since we spoke. How concerned are you going forward? Or have you maybe changed your take on these big companies with deep moats and massive capex?
You know, so much has already been said about concentration risk. I'll be brief, which basically is the following, and that is I'm pleased to see that market breadth has been broadening. That's something that's good news for investors. It's good news for the underlying companies. And I think it's also good for the ultimate stability of the equity market. But let's go back to the point about inflation. Will it become dramatically more problematic? And therefore, will interest rates rise far more than investors are now expecting? I always like to think about risks, both positive risks and negative risks. And one of those negative risks for me right now would be much higher inflation and rates than people are now thinking about. Now, there's a very big difference between what is said during a campaign and what actually becomes policy. But we all know that there are a number of things that could be problematic with regard to the inflation outlook. Tariffs, of course, would be one of those things that could directly harm consumers' pocketbook. We also know that a fiscal policy that focuses in on increasing demand but does nothing about enhancing supply could be inflationary. Changes, for example, to the Affordable Care Act could lead to higher healthcare expenditures, as would the elimination of some aspects of the IRA, which has been keeping pharmaceutical prices down. On a long-term basis, one of the inflation concerns I have is not addressing climate change properly. You know, just take a look at the damage today from California wildfires. It's going to be very expensive to contain those fires, to rebuild, and of course, insurance expenditures. Those premiums are going to go up in these areas, as they already have in areas that have been devastated by floods, such as Florida and other southern states. And so I think we need to be thinking not just short-term about inflation, which, by the way, is under good control, but it's the intermediate and long-term view as well. Fortunately, the new administration is starting with a pretty good slate, a pretty good starting plan. The economy's doing well. Core inflation is under 2%. The one area of concern for inflation is housing costs.
You know, Abby, I really want to hone in just on one thing. We have about a minute left here and really want to get your view on the tariff policy in particular. I know there's a lot of uncertainty, but how should investors prepare for it?
The tariff policy, to me, could be critical. Now, there are some sensible applications of tariffs even in the 21st century. So, for example, if another country is actively dumping goods, then that is an appropriate use situation where a tariff could be used. But an across-the-board tariff is inflationary. It also holds down demand, and the impact isn't felt not just in the United States, but also among our trade partners. I'd be particularly concerned about our friendly trade partners in Europe, who may see not so much inflation, but a diminution of economic growth, and so many of those countries are already on the verge of recession. We also need to think about the impact here in North America. Our biggest trade partners are Mexico and Canada. And a lot of the trade that we see is actually U.S. companies going back and forth over the border, handling different parts of the production process where they think it makes the most sense. And so an across-the-board tariff could, in fact, be very problematic.
Abby, we thank you so very much for joining us today. Of course, a lot to digest in these markets as the country changes. Abby Joseph Cohen, and we thank you so much for your time, formerly of Goldman Sachs, now at Columbia University. Now, coming up, we're going to switch gears. We're going to talk about chip stocks as the slow recovery in the smartphone market mints winners and losers. The stock's up more than 1.6%. We'll talk more about it next. This is Bloomberg. We are seeing moves in chip stocks on the heels of earnings. We're looking at Qualcomm giving a bullish sales forecast driven by signs of a rebound in the smartphone market. But on the other hand, ARM gave a disappointing sales outlook, also citing recovery in the smartphone market, but perhaps by not enough. We're going to look more at what's under the hood with Bloomberg Technology co-host Ed Ludlow. Parse through the noise for us.
Sure. Yeah, I mean, it was a mixed bag, a mixed signal. You know, ARM has really turned a corner. The stock's now up 2%, right, as we just showed. It had been lower both in post-market last night and pre-market this morning. And they both occupy the smartphone space, right? Qualcomm is the biggest seller of the processors themselves, and ARM provides the blueprints and standards that those processors are based on. Qualcomm's outlook signaled a much bigger recovery in the smartphone market, though overall shipment growth of 5%. ARM was a more modest forecast. But what they both agree on is that buyers, particularly in markets like China, are going to the high end of the smartphone market. And so even if you're selling fewer units or the growth in units is more modest, the revenue is higher because of the value of those handsets that are being bought.
So ARM down, though, and Qualcomm up, sort of around the same theme, Ed. How do you sort those two out?
Yeah, I mean, ARM has done astonishingly well as a stock since its IPO. That's, of course, a factor. Qualcomm, to its credit, is a much more diversified business. You know, Qualcomm was a one-trick pony for quite a long time. And under Cristiano Amon, a longtime engineer, someone at the company with a history there, has tried to make it more. You know, I think you will note the automotive success and automotive revenues that Qualcomm has. You know, ARM, there are big questions about how it diversifies its own business away from a reliance on the smartphone market. It does designs and standards for other chips. But yeah, it's a funny reaction. I mean, ARM's now higher in the session. Maybe investors just needed to sleep on it.
You know, really quickly here, Ed, as well,
Sure.
If you look at the Philadelphia Semiconductor Index today on the heels of all of these results, you have most of the stocks in the green. But what's interesting to me is the texture you're seeing here. You're actually seeing the biggest moves in Macomb Technology, Taiwan Semiconductor. What are the ripple effects here that you should look across the chip industry, semi-industry after these results?
Yeah, well, Taiwan's ADRs were under pressure yesterday on the logic that, you know, Trump may be even more aggressive than the Biden administration on onshoring or making more competitive the domestic manufacturing business for chips. But, you know, as you guys know, we talked about it, right? There's been a real frustration from the industry that the CHIPS Act money is nowhere to be seen. It's so hard to get hold of. And whatever, you know, you think of President-elect Trump, you know, his sort of deregulation strategy might just free everything up and allow those companies to execute on the existing plans they have, supporting the sector. And then there's probably a boost to end market demand as well in some senses.
All right, Ed, thanks very much for joining us. We are excited that Bloomberg Tech is back on today after a one-day hiatus for the election. Ed is going to interview the CEO of ARM Holdings. Renee Haas joins Bloomberg Technology at 11 a.m. Eastern. And as Ed pointed out, I think it's pretty fascinating to see that ARM has turned higher. It was down in the pre-market and jumped at the open, now up 2%. By the way, at 10:30 a.m., as you can see from this full screen, Ed has an interview with the CEO of Lyft as well, David Risher. So he's going to join us before Bloomberg Tech and bring with him that special guest. Coming up on this program, Donald Trump may give Wall Street the M&A boost it's been waiting for. More in the Wall Street Beat next. This is Bloomberg.
A pretty big pent-up demand for is mergers and acquisitions. Many companies over the last 3 to 6 months have been, thinking hard. One could say dusting off their dream deals.
And that was Evercore Chairman Emeritus Ralph Schlosstein speaking to us yesterday on Bloomberg Open Interest. And from investment bankers to hedge funds, Wall Street is gearing up for a big return of M&A deals. Hedge fund manager Dan Loeb, just after the Trump victory, said it's morning in America for event-driven investing. Here with more on the M&A front is Bloomberg senior reporter Michelle Davis. Your team is watching a lot of live situations and a lot that may come. There are expectations that the deals could get bigger. They could involve many, many industries. We've heard energy, financials, healthcare, which you've covered very closely for a long time. What are some that are in the pipeline? I'm really interested in Qualcomm in particular, because that is one that you guys have reported will be something that could be considering Intel's situation after an election.
Yeah, so this is the outcome that it seems like all the M&A practitioners were waiting for, because the biggest takeaway is that with Trump in office, the likelihood is that antitrust oversight is going to get easier. So some of those really big deals that folks have had on their wish list for 4 years that they have been nervous to bring to market are a go now. One of those is Intel Qualcomm. At this point, it's still unclear whether Qualcomm will proceed with that deal. U.S.-China relations are obviously a big factor in how that deal goes through, because China will have to approve that deal, and Trump has shown some protectionist tendencies. So that's one of the wild cards when it comes to all of this M&A.
You know what? Sonali's smiling because we had a little bit of a debate this morning. I don't think there's any way in hell that Donald Trump lets a Japanese company buy U.S. steel.
So that's the other wild card, and he has said multiple times that he would block that deal. And so that's the one area where, the bankers and lawyers that we talked to yesterday, they said it looks pretty good for all the M&A, except for when you talk about cross-border. There are certain jurisdictions where maybe, it might not be as easy to do a deal. And there's also the unpredictability factor of Trump. You don't know if there's a company he doesn't like, he could go off and say, I don't want that to go through.
And really quickly here, it's interesting, even Discover and Capital One, which is one of the ones that are expected to go through. The stocks were surging yesterday. A little bit of a give back today, Matt.
Yeah, but they rallied so hard yesterday, right?
It'll probably, it's expected to go through, plus more deals in the sector expected to go through, plus less regulation for these firms anyway.
Bottom line is, we're going to be asking you, Michelle, to come on the show a lot more often. Michelle Davis from our deals team on the other side of the newsroom. Coming up in the next hour, Julia Coronado from MacroPolicy Perspectives on the Fed decision. Remember, there's a Fed decision today, and the economic outlook under the new administration. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is on assignment today. And coming up, Jerome Powell faces a tough test in the new Trump era. The Fed is set to cut rates later today. And in earnings news, Lyft surges after signaling success in attracting commuters. CEO Dave Risher joins us later this hour. Plus, President Biden will address the nation at 11 a.m. Eastern as Democrats examine their fate after a second loss to Trump.
Let's get a check on the markets right now. And just to switch it up a little, let's look at the Russell, because we do have gains on the S&P and bigger gains on the NASDAQ. The Russell has given up the big gains it put up yesterday. It was the big winner. The small caps and the mid caps yesterday overtook the large caps. It was up, I think, almost 6%, 5.8%. Now down about 0.1%. That has not turned around. The 2-year yield I wanted to highlight because there is a Fed meeting. As much as it doesn't matter today, the 2-year yield is down about 5 basis points after a jump with the rest of the yield curve across the rest of the yield curve yesterday. Of course, we still expect 25 basis points. That's not going to change, and I doubt Powell is going to answer very many questions about Trump. NYMEX crude is interesting, not really affected by the U.S. political situation. You'd expect OPEC Plus and the Middle East to sort of rule the roost, re crude prices, although maybe if Trump rolls back regulation, will produce more in this country. Not that we didn't already see a big jump in crude production under Biden, but he says he could do even better, and the price right now is down to $71.28 a barrel. Bitcoin still near its all-time highs at almost $75,000. And with that, let's go to Julia Coronado, shall we?
We shall. MacroPolicy, Perspectives founder and president, joining us now. And, you know, we have to start with that Fed meeting because, to Matt's point, the 2-year moving some, a little bit of a give back from yesterday. What I was more interested in is you saw jobless claims come in this morning. You know, a couple weeks ago, you were hanging on every data point, and now it seems like the narrative around what's happening at the White House is really overtaking the bond market. How do you think about this push-pull between the economic data we're seeing and what the Fed can do in the short term as it compares to what must happen in the longer term at this juncture?
Right. I mean, there's a lot of cross currents going on, as you note. I mean, I think the backup in yields was facilitated not just by the Trump trade per se that became a Trump reality, but also that the data had been reasonably robust. Now, you know, so Q3, the revisions, you know, are all tracking, showing that the economy may not have been weakening as much as we had feared during the summer. Stepping back, though, you know, it is still a balanced labor market. There's no real signs of heat here. We got moderate employment cost index, moderate Atlanta wage tracker. You know, unit labor costs were revised up a lot, but, you know, it looks like a very balanced labor market. It looks like it's cooled off a lot on balance. It's fine. It's moving along. So I don't think that there's like inflation alarm bells being set off. So the Fed has the luxury right now with a reasonably robust economy and a balanced labor market of saying, we're going to like proceed with caution. Saying less is more for Powell today. They don't need to make big decisions about the future. But we kind of have the sense that that first 100 basis points, that's a recalibration based on data in hand. Nothing's going to change imminently to change that. So we think like the bar's pretty high to skip December. Like we're going to go 25 today, probably another 25 in December. And then by the next, then they'll start gathering, have more tangible information about what are the priorities of the Trump administration. Immigration and tariffs are first on the docket for, you know, affecting the economy. Taxes and fiscal policy is going to take a lot longer to sort of negotiate and implement. So how quickly does that get implemented? How significant is it? And how does that alter what has been kind of a very steady as she goes dynamic in the economy?
Julia, I want to go back to, I know it's a 24-hour news cycle, but yesterday we got the results of the presidential election. You are one of the country's brightest minds in economics but you live in Texas. So I just wonder, you know, when I think of Austin, I think of the racetrack and Joe Rogan. What was the reaction around there? My producer says Austin's the Brooklyn of Texas. So what was the reaction? What is your response? How did you take it? Because it wasn't a toss-up. It wasn't a close race. It wasn't a toss-up. It was an absolute domination. I mean, the popular vote, every swing state, maybe a total red sweep.
Potentially a total red sweep. So yeah, I can't tell you, I wasn't like out in the streets, you know, taking the temperature of Austin. Austin is still a blue city, even with Joe Rogan and the new tech element with Elon Musk. So I would imagine there were mixed reactions throughout Texas. You know, Texas is still solidly red state. And the election here wasn't close. The margin got wider relative to 2020. So, it was a solid sweep. But yeah, the fact that it was such a dominating result does have implications for thinking about the policy possibilities. One thing that will affect Texas very quickly, actually, both of those things I mentioned, the tariffs and the immigration policies, are going to affect this state very immediately. We are a high immigration state. We are a border state. If there's a lot of restriction, that's going to affect the labor force here. It's also a globalization, trade state. Lots of stuff comes through Texas from Mexico, ever more given the reallocation in global production. So tariffs could affect, the Texas economy quickly as well. So, again, mixed cross currents here. There's some tailwinds, there's some headwinds. And Texas is going to be on the forefront of any impact.
And to your point on cross currents here, Matt, even in New York, Donald Trump won the percentage of the state of New York even that was the highest by any Republican presidential candidate since 1996. So a lot of significant red forces, even in a traditionally blue state.
Well, I mean, Julia, what does it mean to you? Because, of course, the polls were saying it was neck and neck. And here in our sort of liberal elite bubble, we thought it was going to be a close race, too. But I guess the country does really care about immigration, right? I guess the country does really care about domestic issues rather than focusing on EVs, right?
I think one thing, if you step back and kind of look at global results, there is also an element here of the pandemic just really sucked for a lot of people. Inflation, that burst of inflation was really hard on a lot of people, and incumbents, they're being blamed for it, rightly or wrongly.
Those are the domestic issues I'm talking about, the inflation, right? So.
Yeah, no, but specifically, if you look at the demographics of the shift, a lot of it was working class voters, and they bore the brunt of rising rents, of rising grocery prices, and so you fire the boss and you change and see if that doesn't work better. So I think that there's an element of that. Immigration is an issue that just gets played up every election, whether or not it's real, and it is real. But I'm not sure that was the issue that people were voting on versus, look, it was just a really rough 4 years in a lot of ways. And so why not try something different?
Julia, another thing as we wait to get more results coming out of the House in particular to see whether we're going to have a full red wave or not, tax policy is in question, which also means the deficit is in question. I was fascinated yesterday by a demand for the 30-year auction that was the highest since 2018. Will Republicans be able to keep the ball rolling here with borrowing if you're starting to see more demand at the long end of the curve? Or is the fact that borrowing costs blowing out in the way they are, is that going to create a greater hiccup in the bond market eventually, or sooner rather than later?
Yeah, I mean, we are definitely in a different fiscal position than we were in 2016 when that first round of Trump tax cuts got put into place. So the trade-offs are very different. One, we just have to deal with the expiration of those provisions. And even that, just extending the existing provisions, that wouldn't be fiscal stimulus. It would just be preventing a fiscal contraction, but it would expand the deficit relative to baseline, CBO baselines. So yeah, we don't have a ton of fiscal space by any metric. The bond market, I wouldn't call it a bond vigilante market. As you know, there's still pretty robust demand at the long end. And ultimately, one of the longer term questions is deglobalization, or turning away from, traditional trading partners and trying to turn inward, is that good or bad for growth? Is that good or bad for productivity? These are the kinds of things that ultimately will determine what is the long run neutral yield in the economy. So, there's the initial reaction, and then there's kind of settling in and thinking about what does this mean? You had an earlier segment on M&A. That's a lot of enthusiasm that certain deals will go through. Is that good or bad for competition, productivity, growth? Is a different question. And ultimately, the bond market will have to sort through those questions.
Certainly more questions than answers. Looking forward to covering it with all of you through the next year. Of course, slowly it'll all come to the surface. Julia Coronado of MacroPolicy Perspectives, we thank you so very much for joining us. Catch our special coverage of the Fed decision starting at 1:30 p.m. Eastern. Certainly a lot on the line and a lot of questions about the long term. Let's see what kind of answers we get. We're also going to get a look at stocks moving this hour because there is a lot moving under the hood. Bringing in Abigail Doolittle.
Let's start out with the shares of Qualcomm. They're popping higher by about 2%. They put up a good quarter, beating adjusted earnings estimates by about 5%, sales by 3.4%. They also gave a bullish forecast. This is a bit of a relief to investors given the fact that they create the processors for smartphone. There's been some question around the strength of that market. Apparently new products, along with their ability to take market share. Their Android products in China in particular are doing well, so investors rewarding the company. As for the shares of Lyft, they are absolutely soaring up 30% at this point. This is really pretty stunning. Now, there is a 14% bearish short interest on this stock, so some of this could be a short squeeze, but they put up a good quarter. The outlook's strong. Commuters helping, as is their price lock feature. And then finally, the shares of Warner Brother Discovery higher, up quite significantly as well, up 15.8%. Interestingly, they missed third quarter sales, but their color commentary on this quarter, the fourth quarter, they're seeing strong earnings and subscriber growth. Investors are willing to buy that. Similarly here, Matt, there is a bearish short interest, about 5%. The stock still down 16% year to date, so some folks are willing to buy that view.
All right, Abigail, thanks very much. Looking at a big jump there in Warner Brothers Discovery. Coming up, the holiday shopping season is rapidly approaching. We'll get insight on Black Friday and Cyber Monday with the CEO of marketing and data firm Klaviyo. That's next. This is Bloomberg.
Klaviyo, which focuses on data and marketing automation, continues to grow. The company's revenue is expected to top $900 million for the first time this year, and it struck big with clothing retailers announcing recent wins with the Authentic Brands Group and Rag & Bone. Joining us now, Andrew Bialecki, Klaviyo CEO and co-founder. And it's interesting because you see Wall Street continuing to set the bar higher for you. How do you set expectations on growth at this point in time, given what people want?
Yeah. Well, thanks for having me. We're very proud of the quarter we just put up, $235 million in revenue. That's 34% growth year on year. And staying true to our roots of being a profitable company, 14% operating margin. And as we go forward, I mean, we've always thought about building a business that's a must-have for the businesses we serve. We consolidate data and marketing and messaging onto one platform for the retailers and the brands that we serve around the world, and doing that with high growth and great unit economics. So that's our promise to investors.
So talk to us about the Authentic Brands Get. Obviously, it's at least fascinating for me because they have Brooks Brothers, right? And for Sonali because they have some other brands that I've never heard of.
They own Shaquille O'Neal's brand.
There you go. Shaq's brand. Shoes that'll be too big for me. But it's obviously it's a great get for you. What do you think they see in you? What's your unique selling proposition that they like?
Oh, yeah. Well, so Klaviyo, we think of it as we are the brain for every business. So we help consolidate all the consumer information, past purchase history. So if you're a Brooks Brothers fan and maybe there's a style, maybe you're into stripes or checkers, like with Klaviyo, Brooks Brothers can know that. They have all that customer information. They can know when maybe you last, refreshed your wardrobe. And then they can tailor emails, text messages, other experiences on the website, mobile, exactly to you. So I think the era of one-size-fits-all marketing and one-size-fits-all experiences, that's gone away. With Klaviyo, you can automatically, through artificial intelligence, tailor the messaging, the content, even which medium you use. You can do all of that in real time. And the best part is we measure the results for you. So you can see what's working. And then again, we use artificial intelligence to then automatically optimize those campaigns. That's what we've been working on, and we've got a bunch more cooking on the product side to help drive more growth for retailers.
So I am actually into stripes, believe it or not. You may not have noticed.
I mean, the
But I
striped
appreciate
tie on the
stripes.
striped shirt gives
Yeah.
it away a little bit. You know, Andrew, it's interesting because you also work with a lot of small businesses as well. You're getting into working with many more big businesses. Not to make this too political, but there's an expectation here that smaller businesses might do better under a Trump administration. You've seen just a surge in small and medium-sized companies on the heels of that. But I want to get your view on the ground of how they're doing right now, particularly as you've seen scale really benefit the large.
Yeah. Well, the whole point of Klaviyo is to give the tools that maybe were only accessible to large enterprises to everybody. So we're very proud of the work that our teams have done to help bring personalization and measurements and really, programmatic revenue growth to SMBs. So I think they're doing really well. They're meeting consumers where they want to be met. At Klaviyo, we've expanded the channels that brands can interact with customers. So when we started, it was just email. Now we've expanded that to text messaging. A lot of SMBs weren't sure, where is text messaging appropriate, especially leading into the holidays, how to use that. And that's something we've helped them figure out. As we think about leading up into, Thanksgiving, Black Friday, Cyber Monday, the holiday season, we're seeing a lot of SMBs, a lot of retailers in general, using different channels based on the types of offers they have. So for example, we see text messaging on the rise, for time-sensitive promotions. Maybe they have, a business has some exclusive deals or exclusive drops or flash sales, and they're able to use that. Those used to be technologies that were only available to a handful of companies, and they were big build-outs, and we've really democratized that.
It's interesting, maybe those fundraising for the presidential campaigns, now that they're not going to happen, a small business can send you a text message instead, and maybe you'll buy something, Matthew.
Yeah, and I think, there's still a big chance to bring presidential political campaigns into the future, or into the present, really. They're so stuck in the past still, even though they spend so much money. Andrew, what about outside of the U.S.? I mean, you have, I think, like 30% of your sales outside of the U.S. Does it matter nationality, or is your business now so global and online that it's hardly different?
Yeah, international is a major focus for us. I talk to our customers, and they're around the world. They're in over 80 countries. Up until 12 months ago, we only offered our product in English. Earlier this year, we launched French as our second language, and now we've expanded that to 7 other languages around the world. We've taken our SMS product, which was previously only available in the US and Canada, and we've extended that now to 18 countries, 6 that we just added in the last few months. So I really believe that this trend of personalization and meeting consumers, with, the right products, where they are, that's not just a US, it's not a domestic trend, it's all over the world. And so we're seeing great growth from that. We grew over 40% internationally, a little bit faster in Europe. And we're seeing some great businesses decide to join Klaviyo. The Body Shop, which is a UK-based beauty brand, they have over 30 million consumers, and they had 9 different technologies, which they were able to consolidate all into Klaviyo, a mix of, database tech as well as marketing. So, international is a big focus area for us.
All right, Andrew, thanks very much. Andrew Bialecki there of Klaviyo. This is Bloomberg. Germany's coalition government has collapsed after economic differences led Chancellor Scholz to dismiss his finance minister, Christian Lindner. Scholz is now calling for a confidence vote and a snap election. Joining us for more is Bloomberg's executive editor for Europe, Chad Thomas, out of Berlin. And Chad, I know that Scholz wants the no confidence vote in the new year, but I've heard that Friedrich Merz of the CDU wants to have it next week. So what's the timeline look like right now?
Yeah, so Matt, at the moment, the no confidence vote is set to happen in January, but there is a real momentum in Berlin to move that date forward. As you said, Friedrich Merz called for that timeline to be moved forward significantly, that they would have that confidence vote next week. Christian Lindner, the guy that Scholz just fired, he has now agreed with Merz and said, hey, if this government is over, then let's move on with it. And he's also calling for that no confidence vote to happen next week. It seems hard to see how Scholz's sort of minority government hangs in there for another couple of months until you have that no confidence vote, and then an election 2 months after that. So we'll be watching very closely to see how this timeline plays out in the next couple of days, really.
It was such an interesting coalition to begin with, Chad, having the FDP, the sort of liberal party in the European sense, work together with the Social Democrats. Would Lindner then work with Merz? Does that coalition prove to have a majority, or what's going to happen next?
So at the moment, the FDP and Merz's party, that's the Christian Democrats, that's the former party of former Chancellor Merkel, they would not have a majority. Merz is likely to be the next chancellor. If the election were to happen today, they'll get about 30%. But the FDP, Matt, is polling at 3% right now.
Oh.
That means they wouldn't even get into the parliament. Fascinating
stuff. Thanks for joining us, Chad, as short as it was. Chad Thomas in Berlin on the chances of that government lasting to 2025. Coming up, we're going to speak with the CEO of Lyft. David Risher joins us next with Ed Ludlow. This is Bloomberg. Shares in Lyft are rising after the ride-hailing app smashed expectations for the quarter. The company recorded a record number of trips. It also attracted a record number of unique riders. We have the Lyft CEO, David Risher, standing by with Bloomberg Technology's Ed Ludlow out in San Francisco. Ed,
you know, what's kind of astonishing, right, is the stock as of yesterday's close was down 4% year to date. And now we're up 30% in the session. How things change. David Risher, good morning.
Good morning, guys. Good to see you.
You know what I'm like. I don't want to get into numbers that have already been discussed on the call.
Yeah.
You know, great outlook for the quarter, the full year, the future. What is different about Lyft now?
Well, so I've been in the job about 18 months,
right.
And I've been, I think, laser focused since day one. Customer obsession. Customer obsession. Every time I come up there.
What does that even mean, David? Come on.
Yeah, so fair. It means we want to provide a level of service that is above and beyond anything you have any reason to expect. And right now we're picking riders up faster than we've ever before. We have more drivers on the platform we ever have before. Drivers prefer us 12 points over the other guy, which is fantastic.
Say the other guy's name. Come on.
I'm not going to talk about those guys. I don't even know who you're talking about, really. I got a little confused there. But anyway, the point being that the better you do for your riders, the better you do for your drivers, the more people respond. And that's why we've got all the records that you're seeing.
Just very quick. Detail it matters when it comes to consumer behaviors, psychology.
Yeah.
My research and understanding is that Lyft is very much the commuter space right now. Urban areas, San Francisco is one example where we are.
Yeah.
Tell me more about that.
Sure. So you're right, Monday to Friday, about half our rides are commute rides, which is enormous. Just think of the time people are saving not having to drive themselves and so forth. We introduced something called Price Lock a while back, which allows people to lock in a price, get rid of surge pricing, which you know I'm no fan of, neither is anybody else. And that's had a great effect on commute, because commute people take the same ride every day, but they don't like to see the price bounce around. So it's been a huge success. We've got about 200,000 people who've got a Price Lock pass right now. Keeps growing.
Autonomous vehicles?
Yeah.
Okay, I want to have a really honest conversation about this.
Great.
As you know, it's something that I work on every single day. Our colleagues at Bloomberg Intelligence, our research arm, say that you face disintermediation risk because you're small. You announced a partnership with Mobileye, which is a maker of sensors and system and a chip. I don't see it. I don't understand how that gets you to market with offering autonomous rides on your platform.
Yeah, sure. Love the question. So first, I think AVs are going to be a huge accelerant, actually a TAM expander, addressable market expander for Lyft. Because I think what it's going to do is it's going to bring new product onto the platform that people are going to like. Some people are going to like being driven by a human. Some people are going to think being driven by a robot is pretty cool. Some use cases favor one or the other. So anyway, I think the hybrid future is what we're looking at over time. Now, Mobileye, they make the sensors. They make the tech. You probably have them in your car right now. Lane assist, smart cruise control, all that stuff. That's level 2. Level 4 is full self-driving. So imagine a world where Mobileye tech, which might show up in a Honda or a GM or a Ford or a Stellantis or a Volvo or a whatever, imagine that you can push a button saying, you know what, push this button and your car is now available on the Lyft platform to pick people up and pick them up wherever they are, whatever. So it's a way to sort of, today, if you want to drive for Lyft, that means you're using your time and your car. Tomorrow, maybe you just use your car.
We're getting somewhere now, because what you're describing is very similar to Elon Musk's vision for the Tesla proprietary app.
Yeah.
If you're a Tesla owner, you can submit your vehicle to the fleet, and when you're not using it, it works more like Airbnb than any other platform. But again, it's very hard for people to see the jump there. I'll let you answer, but Uber and Waymo, for example, is very tangible. You can summon a Waymo in those future markets next year, Austin and Atlanta.
Yeah, where are we? Right, I got it. Well, so look, so we're doing both, right? So we just signed an agreement with May Mobility, which is also does full self-driving in Atlanta, and that'll be available next year. So that's fantastic. So that means if you want to have that experience, and by the way, we've given 130,000 rides in Las Vegas with a prior partner as well. So we've got some on-the-ground stuff going on, which is great. And I think it's really important. But I also think the future, where a lot of us, individuals, people who drive today, anyone who has a car, if it's a self-driving car, should also be able to be put on the Lyft platform. By the way, I would extend that to Tesla as well. You use the word proprietary. I think that's right. There's no particular reason why, as a Tesla owner, you wouldn't want to necessarily participate on the Lyft platform, too. So that's kind of the future we're trying to build towards.
I mean, the stock's still up 29%. And so I guess the market believes this vision of the future. Any evidence that Waymo in San Francisco is taking market share from yourselves and Uber?
So we look at Waymo much more as a potential partner than a competitor. Look, if you're a Waymo, you want to be, and
they're not your partner, they're Uber's partner.
Oh, but they'll be both. Over time. I'm not making a prediction exactly. I'm simply saying if you're in the business of creating very expensive assets like self-driving cars, you want them utilized. You want them on the road, and the way you put them on the road is you don't just do it yourself. You end up partnering with a couple of other people who've got that demand built in, which we do. We do 2 million rides a day as it is. So I think if you're one of those companies, your whole job is get the tech reliable, safe, inexpensive, and then commercialize it in a bunch of different ways. And we want to be one of the best partners for them we can be.
David, I have a question about New York City. Since I'm here, I saw an ad somewhere online yesterday that said Uber drivers make $35 an hour per online hour, which I thought was kind of cheap, because I know that Uber and Lyft are locking drivers out of the platform for some part of the day that they can't possibly calculate or know. So they end up spending hours at their job in which they don't make money. How much longer are you going to be doing that to drivers, and why?
Yeah, so it's frustrating as hell. We do not want to do this. Drivers don't like it. We don't like it. What's going on? First, I don't know about that $35 an hour. Actually, I think the number that I know from New York is more like $40 an hour engaged. But anyway, they've got their numbers. We've got ours.
But look, the drivers we've followed around are making more like $15 an hour, right? Because they end up being in their car and locked out of the platform for a considerable portion of the day.
Totally, yeah. Super, super frustrating. It's not something that we want to do. It's something we feel like we're forced to do because of a particular regulatory framework that only exists in New York City. Doesn't exist in New York State, doesn't exist in the rest of the country. And in the rest of the country, even in New York State, we've done all sorts of work to make sure that drivers never get locked out of the platform. But there's this peculiarity around New York and how the regulations are written that are putting both the other guys and us in this terrible position of having to sometimes turn driver supply down just to meet what's called utilization requirements. So believe me, we're talking to the regulators. We don't like it, and I don't think it actually is good for anyone. I think it's an unintended consequence of a well-intentioned idea of let's make drivers make more, and I think it's just having the opposite effect.
Lyft's doing more. I think about some of the partnerships. We had the DoorDash CFO on the show this past week.
Oh,
it's
great.
an example.
Yeah.
But again, you and I have had this conversation, let's say, a dozen times now?
Yeah.
What's the next thing for Lyft, the new business lines? For example, like some people find it really interesting whether you sell more of your data to the OEMs. It's a really interesting case study.
Well, I mean, let me talk about partnerships in general. So, our focus is rideshare, right? That's what we focus on. So when you focus, you can do great work, which means you can have more riders, more drivers, better experience, better service. But it also means if you want to really meet your customers where they are, you need to partner, right? So we just announced a partnership with DoorDash, as you say. I think of it as two great tastes that go great together. I think it's an old Reese's peanut butter thing. Maybe it doesn't land in the UK, but anyway, in the US, that's what we talk about.
I've been here long enough.
You've been here long enough. You kind of know it, so you've drunk the Kool-Aid. You've eaten the cup. But anyway, the point is, you can save on both. As a Dash Pass user, you can save on Lyft. As Lyft, you can save on Dash Pass. So that's a great, type of partnership we've already announced. And I encourage you to link your accounts. But anyway, we'll do more and more of that. So as we provide incredible transportation service, get you out to the world, connect you with other people, we want to work with other partners who can make the experience even bigger.
David, President-elect Trump.
Yeah.
What's Lyft's plan for the next administration and what the world looks like?
Well, I don't know exactly what the world looks like, but I can tell you this. Look, we work at the federal level with all of the administrations over the last 10 years, right? And our big focus at the federal level actually gets back to Mac's question. How can we have sort of federal level legislation that actually helps us recognize that drivers they're not full-time employees. Frankly, it doesn't exactly feel like independent contractor either fully. It feels like a blend of both. And how can we find a national strategy that kind of gives them benefits and so forth? That's what we're focused on at the national level. We also do a ton of work at the state level and the local level. Here in San Francisco, we met with the mayor a couple months ago. We don't know if she'll be the mayor in the future or future person, but anyway, about how can we bring more life to San Francisco.
Just really quick, Elon Musk on Tesla's last earnings call said that in the scenario of a Department of Government Efficiency, he'd use that platform to work towards federal level regulation of autonomous cars. Yeah. Do you support that idea, and what do you want to see happen?
Absolutely support it. Of course, a lot of work has to be done to come up with smart regulation there. But the reason we support it is simple. It's not super fun to have 50 different states to work with 50 different regulations. Nobody likes it. You got to test some things and so forth. At a certain point, though, you need to take a stance, at the country level. I don't know. I think autonomous vehicles are going to be safer. They know the laws. They follow the laws. They've got 8 eyes to our 2. So, they're going to be safer. But it's going to be one of those things we're going to have to step in it step by step so that, frankly, it works for all of humanity, not just for the robots.
David Risher, Lyft CEO, thank you very much for being here in
Thanks,
person.
Ed, a pleasure.
Sonali and Matt, thank you to you as well.
Thank you, Ed, and thank you, David Risher, CEO of Lyft. Fascinating conversation. You can catch more of Ed Ludlow if you stick with us here on Bloomberg Television. He anchors Bloomberg Technology together with Caroline Hyde. They will have, as usual, important intel and fascinating interviews. ARM Holdings CEO Renee Haas is going to join them at the top of the hour. Now, coming up here on this program, the Fed is set to cut rates today as the path forward remains, well, for today, obvious, but beyond 2024, clouded by politics. We're live in Washington, D.C. This is Bloomberg.
I'm going to pull out my best Matt Miller impression. At 2 p.m. Eastern today, the Fed is set to cut rates, and Chair Powell's news conference may provide clues on the path ahead. We're going to get a preview with Bloomberg's chief international economics and policy correspondent, Michael McKee in Washington. 25 basis points is the expectation, but how clear can the road ahead really be today?
It can't be very clear, which is why you have people on Wall Street calling this the most boring and unexciting Fed meeting in a long time, despite your Matt Miller impression. The problem for Jay Powell is that they've already told the markets they're going to do a 25 basis point cut, so they go down to a range of 4.75 to 5%. But after that, there are no new economic forecasts. There is no new dot plot. They may acknowledge that the hurricanes and strikes have confused current data, but basically the economy is in pretty good shape. And, of course, Jay Powell's going to dodge all the questions about Donald Trump. There is no advantage in it for him. So at this point, what we end up with is a situation where it's hard to trade because people are doing the trade on Trump right now. Markets have tended to take the dot plot as a plan. But with Trump, because we don't know what he's going to do, the not a plan dot plot is very likely going to change. It does change all the time, but what does it change to? That's what people want to know. Markets want something to trade against, some sort of guide, and they're probably not going to get much of anything today.
How many questions, Mike, are you guys going to ask Jerome Powell that he is just not going to answer? I mean, is he going to dodge a considerably higher percentage of questions than he normally does?
You know, you could take that to one of the sports books and do an over-under on how many questions get asked. I'm sure there will be a lot of iterations of the same question, which is basically, what do you think of Donald Trump and his plans for the economy and his plans for the Fed? And it's just going to be a standard answer to all of it, that they're not going to engage. They don't know what exactly he's going to propose. They'll deal with the economy as it comes. And so there isn't much for them at this point to say, and anything they say probably in the old Miranda warning can and will be used against them. So I would expect Jay Powell to be very quiet.
You know, we were talking a little bit earlier about this idea of what Powell's term would look like, or the rest of his term would look like under a Trump presidency, and this idea that Scott Bessent, current hedge fund manager, has been close to the Trump campaign, has been floating around a potential shadow Fed. What is it like under the surface, Mike? I mean, with that kind of threat to Powell, how do you navigate that?
Well, that's considered a very bad idea by people on Wall Street because of that very question you asked, Sonali. If the president were to say, look, here is my guy who is going to be the chair after Jay Powell's term is up, or if I decide I want to fire Powell and am successful at doing so, then Wall Street's going to pay attention to that new guy rather than what Jay Powell is saying, and that's going to mess up the Fed's message and challenge the Fed's credibility. So I don't think that happens. One can never rule anything out under a Trump administration, but I think the markets would push back on that. They're already ready to push back in a lot of areas if they think that it's going to be bad for the economy overall. You've got stocks here at record levels. They don't want to see that change. So we may see some more market reactions, some more bond vigilantes before this is all over.
We were looking at a chart today, 291. If you want to access it on your Bloomberg, it's #BTV291. It shows that the market is only pricing in 75 basis points of cuts next year. And at one point, we were pricing in like 170. Is this all due to the Trump trade?
Part of it's due to the Trump trade, but part of it is due to very strong job growth in September, very weak job growth in October. And what are we really seeing here? Today, we got some numbers on productivity and unit labor costs, and the government revised up significantly the unit labor costs for the last 5 years. And you take a look at what's happened over the last year, and we have seen a big jump in compensation for employees, which suggests that people are going to be able to continue to spend and the economy will remain strong. And if that's going to be the case, then the Fed has to think differently about how many times it wants to cut rates. And that's leaving Trump completely out of it. So I think at this point, the dot plot we got in September is sort of off the table because we don't know what will happen under Trump and because the economic data are just suggesting more strength than perhaps people anticipated.
All right, Mike, thanks so much for joining us. Bloomberg's Michael McKee there in Washington, D.C. Catch our special coverage of the Fed decision starting at 1:30 p.m. Eastern. We will cover the 25 basis point cut and all the dodged questions Jerome Powell is asked. Coming up, we're awaiting remarks from President Biden from the White House, scheduled at 11. Could be a little bit later. We'll have that for you soonish. As soon as it happens, this is Bloomberg. All right, in just a few minutes, President Joe Biden will be addressing the nation from the Rose Garden in his first comments since President Trump won an election, won the popular vote, won so far every single swing state. Joining us now is Bloomberg's Michael Shepard in Washington. And, Shep, the only thing we don't know yet is whether or not Trump is going to win, or the Republicans, I should say, the Congress, right, the House, because they've won the Senate. If they do, it'll be a red sweep. How soon until we find out?
You know, it could take a little bit of time, Matt, but I'll tell you, Republicans are growing confident that they may pull this off. There are still 38 races that still need to be called, but the GOP only needs to win 12 of them to hold on to their majority. But we'll have to see. Some of these races remain closely contested, and it could be several days before we know. Remember that 2 years ago, it took 8 days for us to know exactly what the breakdown was. And no matter who wins, we are likely to see a narrow majority for whichever party prevails here. And that will not necessarily give incoming President Trump a mandate to do whatever he wants. The Senate has also pledged to be a check on whatever he might try to do, even under Republican control.
And of course, a lot of policies on the line, particularly economic and tax policies, hanging the balance of the House. Also want to talk about the transition here. We've been talking a lot about potential candidates, who's been in charge of that transition as it pertains to Elon Musk in particular. Very curious about what we know about his role in Trump's circle of trust.
Well, you know, over the summer, he took this larger-than-life role in Donald Trump's campaign, pouring a lot of his own money into it, spending time on the campaign trail, and plugging the Republican nominee's views on the X social media platform that he owns. And that has translated to a position in the Trump circle of trust. We saw him at Mar-a-Lago the night that the former president was able to declare victory over Kamala Harris. And then the former president even name-checked Musk from the podium as he was, essentially declaring victory. He referred to Musk as a super genius. And we even saw this picture of Elon Musk with the Trump family. So that really signals that he will have this position there with the former president as the new administration takes shape. And we can look for him to try to influence what happens as the government is formed with areas that he is most concerned about. These include his pet peeves on regulation that have stymied some of his biggest ventures, including Tesla Inc. and SpaceX. So that is one key area we'll be looking for Musk to have some sort of a role there.
What did we miss, Michael? I mean, I've done a lot of sort of reassessment of my perception of the American voter. I'm sure you have as well. How did pollsters and the media just get this so wrong? Because it wasn't a coin toss in the end. It was a landslide, and only the betting markets saw it coming.
Well, you know, the betting markets, in a way, were really more like betting in the way you might bet on a Giants game or something like that. But they did capture some of the sentiment in a way and that, you know, the polls missed. The polls were trying to adjust for one thing or another. And they also may not have accounted for who did not respond to the polls. And those are the people that over the decades we may have referred to as the silent majority. In this case, a lot of people were not buying the message that Kamala Harris had to present to people on relatively short notice. Her campaign of 107 days really did not have enough time to build the kind of momentum to counter what Trump was offering. His message, which really, you know, was characterized by a lot of grievances and misgivings about where the country was going, that reflected a lot of what people were thinking. And in a way, what they were voting was a protest vote.
Right.
It's easier to vote against something than for something.
We got to leave it there. We're running up against the clock. We thank you so much, of course, and very close to hearing from President Biden coming up as well. Stay tuned for his remarks at the top of the hour. Much more coming up on Open Interest tomorrow, Matt. We have a lot of views from the C-suite to round out a busy week.